Hello and welcome to Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group, and this week I'm back in London.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor as always, but this week from Singapore.
There's plenty to talk about this week. Of course, the hot news is the fact that Donald Trump has brought Putin back to the negotiating table. We've seen lots of market movement off the back of that. Market uncertainty surging. Economic policy uncertainty index has hit the highest level for 25 years.
Yeah, we'll also discuss the potential impact of new tariffs that Trump is looking to issue. And we'll also analyze the US retail sales that have come out weak this week.
So firstly, let's look at the news that Donald Trump's bringing Putin back to the negotiation table. Of course, the market's perceiving this as one step closer to a peace deal between Russia and Ukraine. Zelensky is standing back at the moment, and interestingly, the European countries have been left out in the cold. They had an emergency meeting yesterday, but again, the market is perceiving this as good news. Natural gas prices fell 18% in 3 days on the assumption that gas will flow back into Europe from Russia. The DAX has risen 3.7% in 5 days. That's a new all-time high, up 8% in a month, despite German economic problems. And the UBS Ukraine Reconstruction Index is hitting a new all-time high, up 2.5%.
Yeah, I think overall this is quite a constructive thing. Obviously, war is generally seen in most markets as a bearish factor. In some markets, such as, oil and commodities, it can have a bullish aspect. But to overall productivity within, the countries involved and also countries that have vested interests alongside warring countries, it's generally a bearish factor. And so the end of war is understandably bullish. And I think what we're going to be seeing here with natural gas prices expected to fall with an end to war in Ukraine, and similarly power prices falling, that's very constructive to, especially if you look at European manufacturing, which has been suffering so much recently. If they have lower factor cost of inputs because of cheaper power and cheaper natural gas, and perhaps consumers getting cheaper natural gas, these are all very constructive things. So yeah, it's a positive sign in that regard for European markets for sure.
Interesting as well, it's bullish for European economies, but at the same time, it will be disinflationary. So there's a chance that it looks like Euro area is going to hit 2% CPI target fairly comfortably within a few months. There's a fair chance this could overshoot and possibly heading towards deflation in the latter part of the year. The chart we have here is actually US 2-year yields. It's in a sideways range between 418 on the lower end and 440 on the upper end. And with plenty going on, we discuss in a second some weaker US data. And what we've also seen with the yield perspective this morning actually is a sudden jump in European yields on the perception that the Europe's going to have to announce increased spending towards a European army and defence. So plenty going on in the yield space, which we'll touch on in the next few slides. If we look at US data last week, we had CPI coming in hotter than expected on Wednesday, up 3% year on year, estimated 2.9%. The core jumped to 3.3%. This is largely on technicalities, also wildfires and seasonal adjustments. The bigger news really was weak retail sales coming in on Friday, down 0.9% month on month, estimated to be down just 0.2%. The biggest decline in nearly 2 years there, as you can see from the charts. And JP Morgan put out a 2-year bond buy recommendation. We saw block buying and yields had a big move lower on Friday on the back of this.
Yeah, I think people were anticipating a slump in sales and things, especially imports from the international markets into the US. People were anticipating a bit of a front loading as people were expecting Trump to come in with tariffs. So I do wonder whether it's almost, you see a drop off regardless of the economic policies there. and people just having anticipated these restrictions to trade. So having jumped forward and increased their purchasing at the end of Q4 24.
Also, to highlight the headline risk we're seeing in markets, I was in Singapore last week on Wednesday night, went to bed about 11:30 p.m. after we'd had the CPI news. Yields in the US, 2-year yields had jumped 10 basis points. Woke up 6 hours later and the news of Trump and Putin had come out and yields were suddenly 10 basis points lower. Again, risk we're seeing in markets now, we're seeing much more volatility, we're seeing much more headline risk. And certainly any news coming across the tapes regarding possible peace in Ukraine will see sharp movements in markets. With US economic data weakening, what we're seeing actually is the economics, the Citibank Economic Surprise Index is falling. And here's the charts overlaid with 2-year yields. So we just saw 2-year yields going sideways. We can see how strong the correlation is here. So that's one of the reasons I expect yields to head lower. As we'll see in a minute or two and some slides, the 1-year inflation expectations have jumped. This is largely due to tariffs, but actually tariffs are not inflationary. What's inflationary typically is increase in money supply. So what we're seeing here, I would expect to see yields start to move lower as the economic data is coming in weaker. And of course, correlation with oil, as oil's drifting low at the moment, again, another downward pressure on US yields. So Trump issued some new tariffs, 25% tariffs on all steel and aluminium imports into the US. Particularly hit were stocks in Japan, Korea, India and Australia. They saw sharp declines such as Nippon Steel down 2.6%, POSCO down 4.8% and Tata Steel down 2.3%. On Thursday, Trump also announced he'd signed a memorandum. Here, this is not an executive order, announcing a fair and reciprocal plan, reciprocal tariffs on countries that have tariffs against the US. This is why we saw inflation swaps jump. As you can see from the chart here, inflation swaps have jumped a multi-year high, 1-year inflation swaps. But again, tariffs typically aren't inflationary. People have a choice of where to spend, but the money supply has not changed. That's typically what causes inflation. Moving on to the dollar index. This is now at the lowest level since mid-November. Again, Scott Bessent said, the Treasury Secretary, he wants to target the 10-year yield. He wants that lower. And Powell actually came out this week slightly more hawkish. He said the neutral rate has risen meaningfully since the pandemic. But we know President Trump would want a weaker dollar. Bessent's targeting a weaker 10-year. And as I say, as you can see from the chart here, this is the dollar index. It's clearly short and medium term trend now is lower. It's broken recent lows. And again, if Ukraine peace is announced, the peace deal is announced, then we'd expect that to be very bullish for the euro. So again, we'd expect more dollar weakness on the back of that. Of course, euro is about 55% of the dollar index basket.
Yeah, I think one of the things to look at here in the context of tariffs is obviously if the tariffs imposed make US exports less competitive, then you're going to immediately be seeing less inflows into the US, into the dollar from this trade balance. So that almost acts as a bit of a stabilizer because you ought to see deflation, the US dollar becoming more competitive as there's less demand, and that in turn will make US exports more competitive. So there should be some degree of stabilization going on here between the forex value of the dollar and the tariffs.
Excellent. And how are equity markets holding up to this? The S&P chart, well, it's at critical level here. Looks like a double top, but again, a break above this key 6,114 level will see new buying come in. That's the way many traders trade equities. As it breaks new all-time highs, new buying comes in with a stop loss just below. We've mentioned before, price to sales in the S&P 500 and price to book value at all-time highs. Price to earnings is the second highest level it's ever been after the NASDAQ bubble. But the market trades price action. A good example we mentioned earlier, the DAX is at all-time highs. Well, the German economy is in close to a technical recession. Certainly looks like it's going to be a technical recession. And PMIs in Germany, Purchasing Managers Index, is at 45.0. That's heavy contraction because it's, of course, a diffusion index, with 50 being the key contraction expansion level. So it's a double top. Of course, it's President's Day in the US today. The market's shut. We'll see if it can make all-time highs tomorrow. And if I go on to the next chart as well, the NASDAQ, similar double top level. Again, the market will buy breakouts, even though the market is positioned long. As the market goes higher, new money comes in. Interesting impact from Elon Musk and his Department of Government Efficiency. Washington, D.C. jobless claims have surged since Donald Trump took office, and housing markets are plummeting. You can see here the initial claims in the District of Columbia has jumped. And since Doge began discussing mass layoffs, the median home price in Washington, D.C. has fallen by $139,000. That's nearly 20% in less than 2 months. In 30 days, nearly 4,000 homes have been listed for sale in and around Washington, D.C. We said before, the housing market, well, we know mortgage applications are at 28-year lows. Mortgage rates are up at 7%. Supply of housing is increasing, but what typically starts the tipping point in house prices to fall is jobs going up when people are forced to put their houses for sale. So the housing market seems to be at a tipping point. Takes a long time to play out, but we can see in Washington, D.C., maybe that's a forerunner. And these are pretty extreme moves in less than 2 months.
Yeah, it's worth noting, obviously, that Washington, D.C. is almost a bit of an exception here, as I think the Department of Government Efficiency is going to be particularly targeting jobs in those within the District of Columbia and Virginia adjacent. A lot of the bureaucracy related to the US government obviously goes on there. So perhaps people will be starting to either lose their jobs or have their positions considered as this Doge, Department of Government Efficiency, looks to reduce the number of people employed overall. But it's worth noting in particular that a lot of the rhetoric around this government efficiency is cracking down on non-profit organizations that are being, in the eyes of Musk and some of his six wizards, as they're being referred to. They don't like a lot of what they perceive as being corrupt non-profits taking money, skimming off the top. So I think a lot of those in the US, whether they're legitimate or not, non-profits have a home in Washington, D.C. And so you might be seeing a particular loss of jobs exacerbated in D.C. as opposed to in the US overall.
Interesting point, of course, as well, job losses in Washington, actually it's a small fraction of the government budget. What will have a huge impact as well is if Donald Trump can negotiate peace in Ukraine, but also Trump has gone to China and is discussing reducing spending on nuclear arms by more than 50%. That, of course, would have a big impact on government spending. Also, of course, it'd have a big impact on certain arms companies and their stocks. So one to keep an eye on there as well. Tech stocks in China continue to surge higher. You can see here the Hang Seng Tech Index, highest level since 2022. President Xi over the weekend met with Chinese private sector leaders, including Jack Ma. This is perceived to be bullish for tech. More alignment between the government and the tech companies. So that continues to go. Really that surge started with the DeepSeek, release of DeepSeek, and one-way traffic market rushing into that. We did have some data out of China last week. Sudden jump in Chinese CPI, up 0.5% year on year, fastest rise in 5 months. However, take that with a pinch of salt. Factory gate inflation remained weak, and the PPI index, producer price index, stays in deflation at down 2.3% year on year. On to Brent. Brent, you can see long-term, sitting right on a long-term trend line here. Tony, what's your thoughts?
Yeah, I think we're going to be seeing attempts being made to keep this above a trend line. And that's not just going to be coming from technical traders, as they like to follow the graphs, but more from a lot of the oil producing countries. So if you look at OPEC Plus, I think today they announced that they were intending on extending their cutback of oil supply beyond the April deadline. Well, it's not hugely surprising to anyone because this deadline has been rolled and rolled and rolled. They're needing to do as much as they can to try and augment the price of crude. And with this, with the news of not only Trump coming into power, but also his ambitions to try and broker a peace deal between Ukraine and Russia, that would, if that were to be the case, then I'm sure you'd see huge volumes of Russian crude coming onto the market at, market price rather than having this cap that we had been seeing for the past 2 years. That would act to reduce prices further. So there's going to be a fair amount of defending done, I'm sure, around these sort of $75 per barrel levels on Brent. But in the long run, it seems as though there's no good reason for it to be supported too much higher than this. Things can change. As you mentioned earlier in the show, headline risk is a hell of a thing. So you can still see relatively choppy moves. It's not, this is not to say we're not going to see $80 barrels in the near future, but I think the long run emphasis seems to be, downside.
And again, focusing on that chart, the trend line comes in about $75. A break of that doesn't tell us we're in a downtrend. All it tells us is the uptrend has been broken. The key support is, you can see the last 6 months, we've had multiple lows, lots of congestion around the 70 to 72 level. If we get a break, a close below that, certainly a close in the high 60s, 69.80 or 69.90 or below that, that's when stops will get triggered, and that's when we'd see a fast move lower. Again, purely from a technical perspective, there are lots of technical traders out there, but also those traders that remain long of the market. Where's their stop? Where do they get out if they're wrong? And clearly just below 70 would be the trigger. We've had some strong Japanese data out over the weekend. Strong Q4 GDP up 2.8% annualized, way above expectations of 1.1%. So the Japanese economy is very strong. We have CPI out on Friday. This could be the final nail for another rate hike by the Bank of Japan. Again, favorite chart here, interest rate differentials of dollars and yen. So 2-year US yield minus 2-year yen yield. That is the white line. Dollar yen is orange. You can see the clear correlation. Many things drive currencies, but for G10 currencies, it's predominantly interest rates, and that's clearly moving in favor of Japan. Overnight, the 10-year yield jumped to its highest level since April 2010, and the overnight index swap is now pricing in 38 points of hikes this year, while all the other G10 countries are pricing in cuts. And it's pricing the OIS, the overnight index swap, base rate in Japan at 86 at year end. Again, the previous high we've seen in the Japanese base rate going back to early 90s was 70 basis points. So the market's saying clearly they're going to keep hiking. The economy is strong. We're going to a new 30-odd year high in base rate, and that's going to be bullish of yen. So if we move on to UK data, and then we said some weaker data out last week. GDP actually came in for Q4 slightly stronger than expected, but again, Q4 is now very historic. That's a long way behind us. Month on month, industrial production was down sharply, down 1.9% year on year. And business inventories for December were down 0.7%. So that was year on year. So that's a lot of weakness. We have key data coming out this week. We have employment this week and CPI, two key data from the UK. Again, we know private payrolls have fallen since Labour took office. The market's expecting weaker data. And what we have here is the chart. This is the daily chart of sterling against yen. Again, data comes in weaker than expected. UK yields will fall. We know Japanese yields are strong. So I'd expect to see sterling yen continue to fall. What we've seen here is a long-term trend line. And you can see how the price broke the trend line. It fell. What was a support line became resistance as the price retraced higher. And now this morning, the yen crosses are starting to fall again. So long term, I expect this to go down as Japan's hiking, the economy is strong, as we start to see more and more weakness filter into UK data.
Yeah, it'll be very interesting to see what that CPI figure comes out with. Obviously, in the context of where interest rates have been over the past 10 years since the financial crash, we're still in a relatively high interest rate period overall. But it will be very interesting to see if CPI is high, whether people's choices on interest rates are going to be forced rather than elected.
Absolutely. What do the central banks choose to do? You have inflation higher than expected on one side. And of course, what we've known over the last 5 years where central banks were berated for being slow to hike rates. At the same time, if we're seeing economic weakness increasing, what does the central bank choose to do? I think what we know is what we expect, inflation will continue to fall. Such things as owner's equivalent rent in the US we know is falling hard. If we see the energy prices continue to fall, then we'd expect CPI to fall going forward. And then we'd expect the central bankers to lean on the side of caution with respect to the economy. Mario Draghi was out over the weekend. He was criticising the Eurozone, perhaps forgetting that not so long ago he was in government in the Eurozone. He said Europe has effectively raised internal tariffs while lowering external ones, precisely the opposite of what a single market should do. He's right with what he says, right with his thinking. And we have elections coming up this week in Germany. Actually, on Sunday, Eurozone data is incredibly weak. We mentioned the PMIs. Again, maybe the end of the Russian-Ukraine conflict will be a lifeline that Europe needs. But we had, of course, JD Vance as well being super critical in Munich on Friday of the European Union. And again, I keep thinking euro-dollar lower. But again, the lifeline there is end of Russia-Ukraine war will throw some strength into the European economy. A chart here of the Sensex. We mentioned this before. We'd seen a multi-year trend higher. Well, support has now broken and it's starting to trend lower. Actually, right now it's sitting right on by key support, starting to break. But what we're seeing is dollar is all-time highs against the Indian rupee. Again, this chart, the Sensex, it peaked back in September 2024. We know from positioning, that's key for trading. We know that the market is very long of this. As soon as it starts to break support and the recent consolidation level, if that breaks, we'll see stops getting triggered and again, a rapid move to the downside. We had a huge reversal in precious metals on Friday. Copper was down 3%. The chart here, you can see gold. Well, gold, it's still in the uptrend, but you can see a big move on Friday. It's trying to bounce this morning, but this will be an interesting one to keep an eye on. A break of 2,790, and then that's the recent support. Then I'd expect to see some consolidation and move lower as some profit is taken. Again, the long-term trend is higher. The market looks overextended and due a pullback at these levels. So what's being priced by the central banks going forward? The US market is pricing over the next 12 months, the Federal Reserve will cut 43 basis points. Again, this is going to be volatile, lots of data coming out. ECB, market's expecting cut 77 basis points. Bank of England, 57. Interesting one, New Zealand, 120 basis points of cuts over the next year. We have a meeting this week on the 19th. The market's expecting 47 basis points of cuts. So nearly pricing in the full 50. 2 cuts in one day. The New Zealand economy is very weak, and that's a pretty sure sign that the central bank needs to act, and a reason why the currency's been so weak. We also have the RBA, Reserve Bank of Australia, out this week on the 18th. The market's pricing in 22 basis points of cuts there. The market's fully expecting they cut at this meeting and the next meeting as well. Again, Aussie yen, Kiwi yen are behaving very weakly on the long-term charts. So a brief reminder of risk. We had a meme coin, the biggest ever meme coin crash last week. Libra lost $4.4 billion in, well, it made it and lost it all within 48 hours. The founder of Libra had been associated in Argentina with the government and President Milei. It had perceived backing of the government. It went up, and within 48 hours, there was a rug pull. It crashed all the way down to zero. Just a reminder of what trading certain cryptos and meme stocks, the risk that is inherent with it. On the flip side, Meta has gone up every day since the inauguration. That's an incredibly strong trend. Again, it's gone up. If you look at the RSIs, if you look at the Bollinger Bands, it's a big move. You'd expect to pull back, but it's going one way, and market loves uptrends.
Yeah, I think tech in the US and in China is very supportive. Europe, the only place where it's obviously flagging behind. But we saw after the OpenAI and the Nvidia crash when DeepSeek was announced, there was a strong recovery in those, almost mitigating any losses that they had. And obviously, as you see companies such as Tesla and Meta, there seems to be a lot of work being done by the figurehead CEOs of those companies to get themselves as close to Trump as possible. So we've seen tech in the US supported. And as we saw, the tech sector in China has been really, really strong ever since mid-Jan, the announcement of DeepSeek. And as we discussed last week, obviously, the tech industry in China overall was only trading at 17 times revenue, which was considerably lower than US stocks, which were trading at 27 times revenue. And historically, Chinese tech had been trading at 25 times revenue. So it seems as though tech in both the US and in China is very strong.
And another chart to finish with, chart of the week. This is a weekly chart here, each bar representing 1 week. This is Euro Yen. And you can see it's in a clear, broken the support line, the trend line. When a support line's broken, it becomes resistance. The price action rallied last week up to resistance level, and it's starting to fall again. Interest rate differentials favoring the yen. One risk with this chart, it looks to be in a clear downtrend, but of course, any headline news of resolution to the Russia-Ukraine war would temporarily help Europe. But again, price action says right now this is moving downwards. So data out this week. On Tuesday, we have the RBA rate decision. Again, 22 or 25 basis points, nearly fully priced there. UK employment, that will be a big one for the market to focus on. Wednesday, we have the Fed minutes, housing starts, and UK CPI and the Reserve Bank of New Zealand. Again, 47 basis points of cuts priced there, so nearly the full 50. On Thursday, Australian employment data. Friday, the flash PMIs, US consumer sentiment, and existing home sales. On Sunday, we have German elections, and of course, we have 20% of S&P companies reporting this week. So from a US perspective, we don't have any huge data. Lots of data out of the UK, particularly Australia, New Zealand. But of course, the big risk continues to be headline risk. So keep a focus on that, and good luck this week. Hopefully we'll see you next week. Thank you very much.
Thank you.
The true heartbeat of the global economy, the financial oil market, has remained out of reach for most until now. Introducing Onyx Markets, the first platform to bring personal investors into the ecosystem that sets wholesale oil prices around the world. This is where the real economics of energy begin, a market that shapes so much of our everyday lives. Onyx Markets levels the playing field. Access live, tradable numbers from the industry's leading provider of financial oil market data. Whether you're a personal investor or a global corporation, low cost, transparent, and empowering. For the first time ever, you can trade global oil benchmarks like dated Brent, Northwest Europe shipping fuel, and US Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency. Supported by the world's largest liquidity provider in the financial oil markets, Onyx Markets also brings you insights from industry-leading analysts, detailed reporting, and expert-led education to help you navigate this market with confidence. Onyx Markets, the power of the financial oil market now in your hands. Start trading today. Visit onyxmarkets.co.uk.